Linda McFadden is President and Chief Executive Officer of XCEL Federal Credit Union. How you doing?
I'm doing pretty good today.
You are here to talk about the fact that too many students in this country are winding up going to college. Well, that's the good part.
Right.
The problem is they're graduating with debt.
Monumental debt.
All right. Correct me if I'm wrong, which I often am on one-on-one. $50,000 to $60,000 average debt.
Average debt when they get out.
How the heck does that happen?
Tuition's an expensive business.
I know. I just had a son graduate from Fordham University. You know, had very nice grades, but big bill. How does it happen? I mean, what's the plan, or what isn't the plan, so that 50 to 60 grand winds up being the bill when they graduate?
Well, to begin with, college education has escalated over the past 10 or 15 years.
But it's not like we didn't see it coming.
But did you plan for it? Did the average American plan for the college education that their children were going to need? And most of them didn't, because they're not talking about one child.
Right.
They've got 2 children or 3 children. And then you've got soccer and basketball and teams and family vacations and the important things in life. And then they get to college and they're hit with, how am I going to pay for this?
Concrete advice.
Concrete advice. To plan for it early, to weigh your options. There are many options out there for financing. To educate the student as to the debt they're getting into and make the most of the education. Make the best choices for college, the best choices for their own future. A high school student, when this education should be brought to them during high school, not wait until they're ready to apply for colleges and go visit all these colleges they can't afford. They need to look at this their freshman, sophomore year, meet with their guidance counselors, attend as many seminars, webinars. There's a multitude of educational opportunities out there to teach you the most prudent way to pay for college.
Now, do you think it is, Linda, that most folks are just thinking somehow it'll all work out?
Yes.
That's the plan.
Their
Which
plan
is no plan at all.
Their plan is their child is going to excel and get all these scholarships, either excel in sports or excel academically, and they're counting on scholarships. They're counting on state aid. They're counting on a lot of things.
Counting on scholarships, counting on state aid. That's what you hope for.
Right.
You don't count on it.
Correct. And you can't count on it because it's not there. There are a number of scholarships out there that the students do not even apply for. All the electric companies, all the civic groups, church organizations, all these people are giving money out, but it takes time to apply for them,
right,
and they have to do it early.
But how about this? Say you get some, you don't get others, but ultimately you have the loan.
Right.
You've said, hey, at least pay the interest.
At least pay the interest.
Talk about that.
A few years ago, in about 2009, a bunch of credit unions got together because we have small portfolios. We don't
credit
have the
unions do.
Right, credit unions do. So we don't have the magnitude with the school financial aid offices. So we got together and we said, if we pool together what we have in excess funds to lend out, then we can create a program, a private student loan program, that means more than the federal programs and more than a lot of the other private programs out there. We created a program that is credit-based. The student pays $25 a month while they're in school. That way the student is aware that there is a debt out there, and $25 is not a lot of money to expect a student to pay every month. It's, you know, pizza
Sure.
and beer one night.
But how does it help you?
It helps keep in their mind that they owe this debt. It keeps in their mind that they're paying for this education. It's just not a party at school. It keeps in the forefront that when they get out, there is more to pay later. We found that by doing that, we reduce the delinquency of the loans after they graduate.
What do you mean?
The student or the graduate has been paying all along. They're used to making routine payments on this debt. So when they get out of school and the real payment comes in, they go, okay, I'm used to paying this much, now I'm paying this much. I know it has to be paid every month. I know if I skip a month, I'll get a notice, and they'll call me on the phone, and that this is an obligation I agreed to while I was in school. One of the reasons the federal programs have such a high delinquency rate is that they cut the check, it's need-based, it's not necessarily credit-based. They give the school the money. This child never sees the money. It goes directly to the school. All they know is they can go to the bookstore and spend this, and their tuition's paid and their room and board is paid. And when they get out, they have not thought about that over their years. They haven't maybe excelled in their grades the way they should have
Sure,
because
a few seconds left. And that's what your organization, your organization, the credit
Right.
unions are helping them deal with this.
Right, we are.
Okay. Well, keep doing it because it's important because they can't deal with this debt. Thank you
Right.
very much.